everybody to back to the series, and we're very fortunate today to have Irem Güçeri, who's going to talk to us about R&D and taxes and how firms behave in that context. So take it away, Irem.
Thank you very much, Karen.
Let me just say that the rules here are, we worked this out right beforehand. Please, if you have questions, just unmute and ask them. Clarifying questions are welcome, as well as, according to Irem, anything else. So go ahead.
Thank you very much, Karen, and thank you all very much. Thank you for having me. It's a wonderful pleasure to be presenting today. As you can see, I'm the only author of this paper, so I rely on presentations like this to really improve the paper and make progress on it. I'll look forward to your comments. As Karen just pointed out, I'll be very happy to take comments as we go along and clarifications. I'm going to present to you a model of dynamics of financing frictions in R&D, and I'll talk about a policy context in the UK, which allows me to look and quantify financing frictions. In today's presentation, I won't be quiet kicking the ball to the net, in that I'm going to share the approach and really would like to receive your comments on it as I sort of progress in this project, and hopefully finally have estimates that are more final at some point. But today it'll be more about talking about the context, talking about the model, what I have going, but it is very much work in progress. In this project, I asked two specific research questions. One is how financially constrained unlisted innovative firms are. And the second question is whether the tax policy environment could help to alleviate financing frictions for firms that have large innovative projects and activities. And when we look at the existing evidence base on the importance of financing constraints for investment, we see a lot of body of literature, a rich body of literature that relies on large sort of listed companies' information. But of course, financing frictions are particularly severe for unlisted companies that engage in innovation and R&D. And that's because R&D intensive companies are short of physical assets that can be used as collateral to obtain bank loans. So predominantly, we see equity financing for these types of firms. And the outcome and value of innovation is unknown. So if I go to funders with my project, there is high uncertainty about the outcome of the project, even from the perspective of the entrepreneurs themselves. So it is quite hard to convince people to fund projects, or convince funders to fund projects for these innovative firms. And for those that are really sort of in this literature, you'll know the story about the valley of death, where early stage financing projects sort of are more likely to fail than those that are more mature. A UK policy is helpful in quantifying financing constraints, as it enabled a cash transfer from the government to loss-making companies conditional on performing eligible investment, which is R&D, in a year. Some companies are presented with two options. One is to carry a taxable loss forward and claim against future profits, or claim a cash refund from the government immediately, but you get less money as a result of making that decision. And I kind of stumbled on this question while working on the effectiveness of tax breaks for R&D. So we have a 2019 AEJ policy paper with Li Lu that looks at the effectiveness of tax breaks for R&D, whether they work to increase really the first order outcome, which is R&D. And we saw quite a lot of heterogeneity in the way firms with profits responded, firms with losses responded, and also kind of different types of firms. But in that paper, we didn't have the opportunity to dig deeper into the mechanisms. So this sort of natural experiment allows the estimation of both the extent of financing constraints and the effectiveness of tax incentives for cash-constrained firms using a structural model. And, if you don't think about how tax breaks work for investment on a day-to-day basis, usually studies look at two channels which are almost impossible to disentangle from each other. One is the user cost channel. So if you have a tax break from the government, the cost of capital in just investing in these R&D projects reduces. So with a tax incentive, the net of tax required rate of return to take on new R&D projects goes down. Alternatively, we could get a cash flow boost from the tax break as well, which means if I'm finding external financing costly, this might allow me to use, if there's a tax break, I might still use more internal funds to finance R&D projects. And these are kind of two separate channels. And I think further along the, further down the line, I hope to distinguish between the two channels, very distinctly in this project. What I do in this paper, I have administrative tax returns data that I can match with balance sheet and income statement information from the UK to analyze the relationship between financing constraints and investment. And I'm going to say a few more words about the data when we get to it, but I basically have the population of all UK firms, and I can see how much R&D they perform, how much tax they pay, and some other outcomes. I build and estimate a structural model to pin down the mechanisms underlying heterogeneous responses to policy. Now, I provide evidence based on policy variation across different subgroups of companies and over time. Often, looking at the literature, we do not have access to information that might be used as proxies for unlisted companies' financing frictions. Most of the time, we see studies looking at small versus large firms, young versus old firms, but the kind of variation that we get from this policy has a special structure that reveals the extent of such constraints, and the paper discusses the effectiveness of a measure that may alleviate them. So what do we already know about, financing frictions as well as the effectiveness of tax breaks? And I believe to speak to three strands of the literature, but also open to discuss others as the audience sees fit. So the large body of literature on financing frictions say that financing frictions explain a large part of firm responses to investment incentives, but of course there is they're very difficult to measure. So there are proxies that have been developed in the literature. There are some more sophisticated methods that have emerged lately, and probably, arguably the model that I am going to present to you today speaks to this literature and gets inspiration from this literature quite a bit. Second is that financing frictions are particularly steep for R&D intensive firms, and R&D intensive firms do respond to tax incentives, which is something that the existing literature pinned down, and that there are heterogeneities in responses. And I'll refer back to my own work on R&D tax breaks. What we find is that on average, firms respond to incentives, especially smaller firms, and we see that younger firms respond more than do older firms. And that's as much as we can say about firm behavior and financing frictions from reduced form evidence. Finally, there is an old kind of theoretical public finance literature that looks at the asymmetric treatment of losses. As we know, every additional dollar of profit for firms gets taxed at the marginal tax rate, but every additional dollar of loss doesn't get a refund in a similar way. And if I'm kind of persistently loss-making, I'm going to be less likely to respond to incentives for investment, especially those that use the tax system, because I don't have taxable income for the foreseeable future, probably won't be responding to such incentives. I'll probably skip the discussion about asymmetric treatment of losses, but I've spoken a bit about the body of literature that exists. So how is the current setup that I'm going to present to you today different from the other studies? The first one is to say that I can quantify financing frictions for privately held innovative firms. And what I aim to do, and I'm not going to do that in this presentation, but to actually estimate the financing friction separately for the pre and post 2008 periods. because the financing friction itself, or cost of accessing external financing for these privately held firms, is not a deep structural parameter, but it's a construct of the capital market environment. It is subject to change in times of recession, like the one we had in 2008. Second, potentially, again, the setup will allow me to distinguish between different channels through which policies of this kind might work. There is a focus on knowledge capital, but in this paper, I'm going to be treating knowledge capital as analogous to physical capital. So firms will be accumulating knowledge capital by investing in R&D. I do have very, very detailed population data, so that is certainly an advantage. There is exogenous variation in the cost of capital through policy changes and tax rate changes. The cash now relative to the cash later decision varies exogenously and endogenously across firms and over time, and I'll definitely detail that part. I will show, I'll skip that bit. So there is quite a rich setup that hopefully in the future will allow me to answer some questions that we don't know the answers to in this space.
Can I just ask a clarifying question?
Sure.
How confident are we in measuring R&D well? So I just know that in France there's this policy to subsidize R&D, and there are some people who claim that there are all kinds of things which are made to look like R&D but are really like marketing or stuff like that. So
yeah, so there is absolutely. So there is a sort of a Frascati manual definition of what R&D is, and it's something like accumulating knowledge that the firm didn't have before. And there is something about the knowledge should be new to the world as well. Of course, that's a very sort of vague definition to place sort of information into. And what the firms are kind of, from the policymakers' perspective, one of the biggest worries is their relabeling of existing spending as R&D. And about 50, if we look at the aggregate data, and I think this is quite similar for France as well, is that about 50% of R&D spending is actually wages of people. So if we kind of put a lab coat on administrative staff, would they become R&D employees as a result? And the big policy debate in the UK right now is about how much relabeling there might be. Now, what we've done in the previous paper was that we looked at the reduction in other expenses, in response to a policy change. As R&D goes up, do we see a reduction in other expenses? Because that would actually be a sign of relabeling. We did not find statistically significant evidence for such relabeling. In fact, even the quantities were quite small to argue anything of that kind. There is a recent paper that looks at China and the Chinese political context. Political, of course, it is different, but also the policy context is quite different. And so there, the authors have found about, if I'm not mistaken, 30% relabeling of the expenditure. So it's, 30%, or $3 of every $10 or yuans spent on R&D is kind of other stuff that's not R&D. So it is a genuine concern. I will abstract away from that concern in this paper, saying that, well, actually, we sort of, based on other explorations, we didn't see such relabeling in the UK. So what is this sort of, is this a fringe policy that I'm talking about that kind of, applies only to a few firms? Well, actually, it is a very popular way to subsidize R&D by the governments. So the dashed kind of bits of the bars here are the direct funding of business enterprise research and development from the government, and the sort of the red straight bits of the bars are the tax support for business enterprise research and development. So some countries use this tool intensively and some of them don't. So if you look at Germany, you see a negligible component there. They use other ways of funding business R&D. But if we look at the UK, and the y-axis here is percent of GDP. That's why they're sort of tiny values. But of all the support that goes to business R&D from the government, more than half goes through tax incentives. France is, at least the data is not like last year, it's maybe 2 years old or so. So according to this, France actually does use quite a bit through the tax system. Similarly, Australia, Canada as well. Great. What happened in the UK was that the UK didn't have a tax break until 2000. And then there was a small and medium-sized enterprise scheme that was introduced in 2000, and then a large companies scheme in 2002. Small and medium-sized enterprises were eligible for more generous deduction rates and immediate cash if they're in a loss-making position. This scheme was expanded in 2008, and more firms gained access to immediate cash when in loss-making position. Now, when I started this project, and believe it or not, it was a while back, I wanted to exploit the 2008 change in policy, but more and more as I sort of researched into it and thought about the financing frictions, it made more sense to actually run the estimations in the pre-2008 period and then compare them with the post-2008 period and actually infer something about the change rather than exploit this change as an exogenous variation for the purpose of quantifying financing frictions. Now I'm going to tell you about what the policy actually does. Let's look at the 2006 situation. So suppose we have, so let's just only focus on the top panel of this table. Suppose you have a company that spends £100 in R&D in 2006 and it has a loss. And it knows with certainty that it's going to switch to profit in 2007. And suppose it doesn't discount anything, okay? If I take the cash from the government today for the £100 of R&D that I've performed in 2006, I'm going to get £24. If I wait a year and I, deduct the tax, the tax deduction from profits, then I will be deducting £45 if I make lots of profits, or I'm going to deduct £30 if I don't make lots of profits, but still I have taxable income. And then when the policy becomes more generous, actually the rates don't change that much in effect, except that if I don't make a lot of profits, I make small profits, then the tax deduction becomes even more generous than it was before. So maybe after 2008, I'll have even more incentive to wait and carry forward to a future, profitable period. So with multiple periods, there would be two reasons to take cash now. One is that I don't know when I'm going to become profitable, and more realistically, I don't think I'm going to become profitable anytime in the near future. So I'm going to take the cash today. Or external financing is so costly for me that I am going to, I'm just going to take the cash today. And by external financing, cost of external financing, what I will mean is the, dollar cost of raising funds externally. And I don't think about a situation where I'm completely out of the market if I don't raise these funds. It's more that it's just costs me money to go and get the cash, externally rather than have it within the company or get it from the government for free. There are 4 policy regimes, like this generates 4 policy regimes. If I could be small before the reform, small after the reform, large before the reform, or large after the reform. I don't want to spend too much time on it because I'm not going to be in this presentation exploiting this variation too much, but I'm going to be looking for your views on ways to maybe leverage this environment. But you can see that if you're a large company, you don't get any cash at all. Today you can, but for the period of this research paper, there was no cash available for large companies. And then the deduction was much less generous than it was for smaller companies. And how do we define small or large? Well, we define it by firm, employment and either balance sheet size or turnover, which is like revenues. For the purpose of the model, I'm not going to have information, I'm not going to use information on employment. I'm going to look at the change in turnover, and based on that change in turnover within, like, for the firms, they're going to move between regimes. I already mentioned that we have about 1.5 million corporate tax returns per year, and the period for which we have this information is 2001 to 2011. It has R&D tax credit data, whether they're large or small, any cash refunds, any loss carried forward, claimed against current profit, revenue, taxable profit, etc. And then we have the balance sheet and income statement information that gives us useful data on shareholders' equity, debt, and other types of external funds. Many companies take the immediate cash option. So I'm going to now give you a few descriptives about the data. So while about a third of companies carry forward so if I'm, this is all the companies that are loss-making and that perform some R&D. About a third in each year choose the carry forward option, so not take the immediate cash option. About 2/3 take the immediate cash option. And the profit, loss, and cash decision actually correlate quite a lot with a company's R&D intensity. The more R&D intensive I am, the more likely I am to also make a loss and also take the cash from the government. And the less R&D intensive I am, the more likely I am to be profitable. So if I'm profitable, of course, there is no decision there. I just take the deduction. Size doesn't seem to be actually a good proxy for predicting this decision. So if I am a small firm, like below the 50th percentile, that's captured by the straight line here for firms that carry forward, and dashed lines here for firms that take the cash. So actually, size almost, is uncorrelated with this decision to take the cash or not.
Do you have age of the firm as well?
I do actually, yes, I do. I commented that out because the way I visualized that data was not very good. Age is actually much better at proxying for this decision. But yeah, that's something I should bring back to the presentation.
Can I ask a different question? So given that there is a difference in the R&D intensity in these firms, do you have information on how their other operations are? Do their other operations impact, these kind of, because you might think the firm overall is not thinking just about R&D, but also about their other operations, and to the extent that the R&D may be just, for some firms it's a small amount of operations, and another it's large. Do you have a way of sort of controlling for that?
So I use R&D intensity as R&D as a share of total revenue, and sort of using revenue in the denominator is kind of my way of trying to control for it. And I don't use the other bits of information that are available in the balance sheet and income statement because they're not very well filled for this size group of firms. In that, so this is kind of like the publicly available Bureau van Dijk data. Larger firms are required to fill that information, but these smaller firms are not. So I think if I sort of dropped the missing values and then looked at it, it would be a very skewed sample. If I look at the tax return, and I know that the US tax return has much more information about things like different types of operations of firms. Here, the tax return starts at something that the UK tax authority calls trading profit. And by the time you get to trading profit, you've already deducted salaries, you've already deducted interest expense, a whole lot of other things that you would do. So it's actually, it's great data, but it's not that great when it comes to the detail of operations. Now I'll get to the model, and I'll start with a sort of a 2-period model to fix ideas. This is not what I intend to estimate at the end of the day. It's the dynamic model, but just to give a sense for the kind of decision that I expect firms to make before I move to show you the dynamic model. So firms in the 2-period model start with no capital, and they start to invest in knowledge capital. The government government allows a super deduction at rate Q of the cost of purchasing knowledge capital, so R&D investment. So every $1 of investment will be counted as 1 plus Q for tax deduction purposes. So that allows you to deduct an extra few times the tax rate if you're profitable. So in the beginning of the period, the firm makes all its decisions about investment and financing. And to finance the initial investment K, firms can supplement the external equity X that they get with some government funding, the government cash back at rate phi, and raise the remaining amount by issuing external equity X, because the government amount is never going to be 100%. And the second option is to set off this amount against profit arising in period T equals 1 to save on the tax payment. So in this case, the firm would have to raise a larger amount of external equity, and external equity has a cost of lambda. Here, so you only incur this cost if you raise external finance, but of course, in this very simple model, you will have to raise some external funds, and the firms are constrained by the sources and uses of funds identity. So the R&D that you can invest in is equal to the external funding that you raise, plus any kind of future cash that you may take from the government. And if we rearrange things and assume that this sort of cost of external financing is a proportion lambda of all the external financing that we get an expression that I will use in the next slide. So what we have here at time t equals 1 is that the firm observes its period shock A1 and starts production. So the firm's maximization problem in this kind of very simple version of the model is that I produce something, I make some revenue, but then I've spent K on, raising this knowledge capital. And the net of tax amount that I get from it is sort of revenue net of investment times 1 minus the tax rate. And then I get this extra deduction if I haven't taken the cash, this D is equal to 0, and then I get an extra deduction from profit of Q times K times tau, plus if I've taken the cash today, then I get this sort of small cash flow from the government net of the cost of any external financing. So if we think about a case where the firm expects to make a profit at T equals 1, the firm will choose the cash option only if the external financing cost is sufficiently large. So the external financing threshold, the threshold value of lambda for any firm to choose D equals 1 is the tax rate over the cash rate from the government. And I think, so it's something like if we have a tax rate of 25%, and if we have a deduction rate of 16%, what we get to is something like a 25% of external financing cost should be getting me to, let's assume that the tax rate is 20% and the cash rate is 16%. Then about 25% should be enough to get me to choose the cash option. So what I mean there is that, we have the So I have to be finding, I have to be losing about 25% of the funds while I'm trying to search for those funds to accept the cash option from the government at the expense of future higher deduction. So here I'm showing two scenarios. The scenario up top is the optimal capital if I don't have a very high cost of external financing. So if my lambda is only about 5%, then the value that I get from not choosing the cash option is higher and I accumulate more capital. If I have a high lambda, something like if I lose about 50% of the funds that I raise externally because it's so costly for me to raise external funds, then my optimal level of capital is much lower, of course, but I'm also better off taking the cash from the government.
Can I just ask you, what exactly are you plotting there? Is that the profit of the firm?
Yeah.
Those two conditions? So
exactly. So it's kind of exactly, yeah. One is the profit from D equals 1, and one is the profit that I get from, or actually let's call it cash flow that I get in a situation with D equals 0. So here that's the one. And here again, the cash flow that I get from D equals 1 up top and D equals 0.
And so the difference in the top and the bottom is just as you have high lambda and low lambda.
Exactly. Yeah.
Okay. Got it.
And the real world is, of course, more complicated because we need firms to optimize dynamically, where firms are going to face uncertainty about their future profitability. So we assumed in the previous one that firms are, around that decision to almost be profitable. But here we're going to be uncertain, and on a year-to-year basis, we're going to be experiencing some persistent shocks. And we have to kind of incorporate the possibility that firms might be expecting not to get into profitable position in the near future that will affect their choice of taking the cash, as well as the financing constraint. And in the previous almost static version, we had firms not having that type of kind of persistent uncertainty.
So can I just ask, in your time series, in your data, do you see evidence of cyclicality in the choice of the firms? You would think that the external finance is cyclical.
Yeah, there should be. I mean, I think just looking at the raw means or raw counts of observations, we kind of don't, because it seems like, say, at least an obvious kind of downward sort of shock is 2008 and thereabouts. And we don't really see a big difference between carrying forward and taking the cash option. But my expectation is that maybe I can do variations on that could be more revealing of whether there is cyclicality or not. So I think that's something one could look at.
Yeah, because this is surprising, no, in some sense.
It is, yeah, yeah. It is, and it's sort of, I mean, it is a bit of a blunt measure, but it is surprising that we don't see a massive hike in taking cash.
One question I had, since you have this slide up, is you have the count of observations, but one question is the market value of it. I mean, and that's kind of a bit to Helene's point is, you might think that this is conditional on what is the value of the market and also what is the value of the actual amount they're taking. And I think you have data for that. So that might be something to.
Because these firms are private, actually, it's not very easy. That one could use proxies, and we can discuss what would be good proxies. Like, is it sort of dividend distributions of firms, or is it the actual profit they make, or anything else? In the model, I'm going to say the present discounted value of all sort of future distributions is going to be the kind of a determinant of the value of the firm, but it's not actually quite obvious what would be the right proxy to look at least to get a sort of first sense of whether there's cyclicality in the financing constraint or the cash option.
Just to make sure I understand. So this is number of firms per year that are, for example, taking the carry forward.
Yeah.
So, but I mean, one obvious question is how many firms are there per year? I know you have that, because I know in the United States, the number of firms has actually changed over time. And so that's at least one metric to sort of compare to. But anyway, don't mean to sidetrack you.
No. This is yeah, okay. Maybe we should get back to this.
Since you have now 20 minutes left.
Okay. Yeah. And I think this is something we should get back to, because it's I've played around with various obvious proxies, and there wasn't a very clear pattern for assessing the cyclicality. And in terms of, the total number of firms, it's like 1.5 million every year. Out of those, maybe 3,000, 4,000 perform R&D. So it's not like a large number of firms report having done any R&D in a given year. So it's actually kind of reduces the sample quite a bit to a very select group of firms. We can discuss, but let me walk you through the dynamic model. And then we can sort of open up to questions as well. So I'll start with a world without taxes or financing frictions, and then I'll move to introduce taxes, and then I'll move to introduce financing frictions. So the simplest version of the dynamic model would involve, firms with some knowledge capital as the only input that they have, or we can think about a world in which everything else is optimized out, and they're maximizing the value. And here, because because there's no external financing or taxes, the operating profit in period T and then all future values of operating profits kind of determine firm value. We have a Cobb-Douglas production function and some productivity. A tells us the permanent firm-specific productivity parameter, and epsilon is our AR1 kind of shock term. There will be a production friction and an R&D investment. I will assume the production friction to be 0, so there won't be firm entry or exit in this model. The knowledge capital is accumulated the same way as we would expect physical capital to accumulate, and I know that opens a whole can of worms that we can debate and discuss, but that's what the model is for the time being. And knowledge capital depreciates at rate delta K. R here is R&D spending. The shock process, the firm-specific period productivity shock, follows an AR1 process with rho as the persistence parameter. And we have a basically sigma to be one of the, again, structural parameters that we will estimate. It is the variance of the shock term nu here.
So the productivity doesn't depend on R, it's only the
No, it doesn't, yeah. Hence I said it opens up a whole
okay, sorry.
One could, yeah, and perhaps one thing to discuss at the end is whether the model should be modified quite a bit to accommodate that. At time T, the firm decides on how much it will invest the next period after it observes the period shock epsilon. Competitive prices and outputs and inputs, and prices are normalized to 1. The firm's only input is knowledge capital K, which is accumulated through R&D spending R. Investment, once I've accumulated that knowledge capital, I can't sell it. It's with me forever. When we introduce taxes, firms basically pay pay taxes on their profit at rate tau. The government allows R&D to be super deducted at rate D. Now it's just, we moved from Q to D in this version of the presentation. Profit-making firms use the deduction to reduce their tax liability as incurred at period T. And eligible loss-making firms have two options. One is to take cash from the government at rate phi, and second option is to carry the deduction forward to reduce future tax liability as soon as the firm enters profitable position. So now we have an extra state variable H, which is the total cumulated losses that I have, because that's what determines basically how much I can deduct from profit in the future. So that's a really important state variable to determine whether I'm eligible to use the cash option or not, and a choice variable, which is DIT. So in addition to how much capital I want next period, I also decide on whether I'm taking the cash from the government or not. So now the firm's optimization problem incorporates that new state variable H and also the new choice variable D. The operating profit kind of is a modification of what we had before. And I will only ask you to take my word for this sort of summarizing the accounting environment that we're working with. And it's a whole bunch of laws of motion for different variables with variables that I'm modeling. I'll just skip this to save everyone the hassle of massive notation. Final thing we need to introduce is costly external financing. So to fund investment, firms can use their retained earnings, which are free to use within the firm, period profits, government cash option if they're in loss-making position, and external equity, which has a cost of lambda x. So if we have SIT capturing the beginning of period retained earnings stock for each firm, then firms can use existing resources to fund equity payouts. And now our sources and users of funds identity becomes the following. So this is the next period's retained earnings. And then this is this period's retained earnings. So if I'm not doing anything else with it, I can put it, it basically earns an interest at rate R, small r, and I pay tax on that sort of interest that I earn. My period profits plus any external financing that I raise. So
can I just ask, what is there must be a connection, I imagine, between the retained earnings and what you had before is the H, which was the accumulated earnings in the past. Are those connected? And
they are kind of not, unfortunately. I mean, I think I was sort of, I introduced retained earnings as a new sort of state variable separate from H, because H is a loss stock. So it kind of has the negative, it's the opposite effect of what I have as retained earnings. So the loss stock allows me, so if I make 100 of loss today and 100 of loss next year, my H is 200 2 years from now. And if I made 300 of profits 2 years from now, I can deduct those 200, that H, from 300 eventually. Whereas retained earnings are positive things. It's kind of like the opposite of H, but their use is quite different because they are basically free funds to finance investment.
right, but I understand they're opposite each other, but I would think there would be an accounting that would,
Need to consolidate.
you can have retained earnings or you have losses, and so there should be some connection. Anyway.
Yeah, I think unfortunately you can have both accumulated at the same time, and that kind of complicates things. But that's
we can talk about it later.
Okay.
All right.
So any external financing that I raise is going to actually cost me a proportion lambda. So it costs me to go out and find an angel investor or whoever I need to take the money from. And if I'm not raising external equity and I made good profits, then I can distribute the earnings as dividends. So I'm not distributing dividends and raising external financing at the same time. I'm doing one or the other. So X captures both these activities. And only if I'm raising external equity that I incur this cost lambda. But if I'm distributing dividends, it's free to distribute dividends, of course. Okay. So, sorry, I had a few. Okay, so we can estimate the production function parameters using dynamic panel GMM, and I solved the dynamic discrete choice model and minimized the weighted distance between simulated and empirical model moments using simulated method of moments. And then I would like to reconcile this, all these structural ideas with some reduced form estimates using difference in differences. But again, that's kind of a bit questionable because we have this reform taking place in 2008. So that's not necessarily the kind of ultimate approach that I'm going to take. But I just want to alert to you that that option is available there. If we run the dynamic panel GMM on, as a production function with capital or R&D capital as the only input, then I would like to raise your attention to the fourth column of this table. So the system GMM says that we have a persistence parameter of around 0.67, and we have the sort of coefficients on capital of 0.69 and the lag of capital as minus 0.61. What does this all mean? I would like to kind of just park it there and move 2 slides. So the financing friction parameter I estimate using simulated method of moments, and that's going to come next. Let me move to the estimates here because we're both short of time, and I would like to sort of show you what the end goal is a little bit. So we have a persistence parameter of 0.67. We have the variance of shock term, elasticity of output with respect to R&D, and we find that the financing constraint is about 14% for highly constrained firms. And in this version of the model, I basically allow for half the population to have a low constraint and half the population to have a high constraint. And then I say, what's the difference in the degree of financing constraints these two groups have? And the group that has the low constraint seems to not have a statistically significant financing constraint really when they go out and raise external financing. But the group with the high constraint seems to have about 14% of their external funds evaporated as they go out and raise external funds. Again, these are not final. These are kind of just looking to quantify the effects, and I'm still revising the estimates here. What I want to finish on, sorry, I'll just take a look at what I have. What I want to finish on is some reduced form evidence that I would kind of eventually like to reconcile this with, but that's from an earlier paper, is that I have these different regimes, and we have a group of firms that had previously been labeled as large that all of a sudden became for a policy perspective, became small and became eligible for a much more generous set of incentives. Now, if we look at their response to R&D incentives, and this is from our earlier paper, we see that the treated group of firms, which became now eligible for more generous R&D tax breaks increased their R&D spending quite substantially. And we see that actually younger firms, so that's the third row here, younger firms increase their R&D spending differentially much more relative to older firms, which did not significantly increase their R&D spending in response to the policy change. Now, what I'm kind of leaving up in the air with this is that how can we reconcile the kind of reduced form analysis here with the sort of model that I shared or a variant of the model. And I would like to conclude basically with an open question about sort of the next steps. And applying the model to data, the paper envisages 4 contributions. One is to talk about the mechanisms. Existing literature takes it as given that investment incentives work through the reduction in cost of capital, but this paper aims to reveal the extent of the cash flow channel and how firms respond to financing constraints. Second is to quantify the extent of financing frictions for private innovative companies. Third aim is to sort of pin down unobserved heterogeneity in financing constraints, but also in productivity. And finally, the aim is to carry out counterfactual policy simulations. So after revised estimates, we can test responses to a range of R&D support policies in terms of R&D and innovation performance. And in preparation for this presentation, and I omitted that kind of figure from this presentation, but if we switch off the cash option that was given to firms, we see that the R&D spending would reduce dramatically. Because we have these 4 different regimes, we see that how different firms will react. And in the structural model, if we don't allow the firms, the same firms that were performing a certain amount of R&D, the cash option, they would almost halve their R&D spending from around something like £200,000 a year to around £100,000. And we could experiment with alternative policies as well. How would the effect of increasing, changing the tax rate affect R&D spending and some other policies? So that's where I would like to go. But as I've said in the beginning, the aim of the presentation was to get your views on the approach rather than to really kick the ball to the net and say, here is what the policy implication would be, because the estimates currently are not final. Thank you very much for your questions and for your attention.